Hello everyone, this is Andrew McNair from SWAN Capital with our February 2023 SWAN report. In this month's video, we're going to discuss some recent headlines that influence the financial markets, but I also want to provide you some perspective on what these developments may mean for you over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. Now, if you watch the state of the markets, you know that our market outlook remains cautious because of inflation and rising interest rates. Now, if you haven't watched the state of the markets, go back and check that out on our YouTube channel. But markets had their best January since 2019, and the upward momentum has spilled into a strong start to February thanks to the dovish Fed earnings haven't been as awful as expected, and there have even been some significant surprises to the upside. 69% of the companies in the S&P 500 have actually reported that their fourth quarter results have recorded actual earnings per share above estimates, which is still below the 5-year average of 77% and the 10-year average of 73%. So in aggregate, companies are reporting earnings that are 1.5% above estimates. So that's a good sign. We are back to the market trying to outthink and outmaneuver the Fed. Now, remember last August when Chairman Powell stopped the markets in their track by stating that the Fed was nowhere near pausing. Well, this month he signaled we're closer to the end with rate hike, and thanks to the resiliency of U.S. companies, we're actually at levels where we can have a strong year, barring any significant events. But just as I say that, we should all keep in mind that something unforeseen can pop up at any time. The Federal Reserve met last month and raised rates by 25 basis points, bringing the Fed funds rate now to 4.5 to 4.75. In less than a year, we've gone from zero to current levels. That's pretty crazy. Now, the Fed has slowed a bit, going from 0.75 to 3 meetings ago to 0.5% in December and now 0.25% in January. So it's clear that inflation and wage pressures are declining. But Fed Chair Jerome Powell declared that the job is still unfinished. He went on to say that this disinflationary process has started, and if conditions deteriorate too much, the Fed will act. Well, is it all talk? Smaller rate increases are closer to a pause than an acceleration of rate increases. So in my view, tough talk costs you nothing. And with inflation coming down and real wages actually falling, continued job growth is the only fly in the ointment right now. The Fed's next move is pretty obvious amid a constant drumbeat of layoffs and a slowing economy and a ubiquitous talk of recession. We're just now beginning to feel the impact of the Fed's tightening from last year. And as mentioned, employment continues to be a thorn in the Fed's side. The ADP report came in at 106,000 jobs for January, which was less than it was 235,000 that we saw in December. So this is a good welcome signal. The latest Bureau of Labor Statistics, we call it the BLS Employment Situation Report, actually blew the doors off the consensus, where 187,000 jobs coming in at 517,000 jobs. So if we look at the JOLTS survey that came in December, it showed 11 million jobs, over 10 million for nearly a year, despite all the high profile layoffs that we saw from the tech sector. So I'm wondering if a recession will impact higher paid workers more than lower paying leisure, retail, and food sectors will have jobs available for anyone who wants them. Will we see unemployment rise while openings remain elevated as higher compensated workers actually collect unemployment benefits and lower paying service jobs actually remain unfilled? This scenario can occur, and if the Fed is looking for job growth to weaken, it might be waiting for a while. That's going to be it for this month's SWAN report. I want to thank you for listening every month and check out the new digs. We're in a different location today. Please remember that nothing we talk about here is a recommendation specific to you. If you want to discuss your personal financial situation, please give us a call at 850-380-9558. That's 850-380-9558, and we'll be happy to talk to you then.